Hello and welcome to the Weekend Investing Daily Bite of 15th of October. And the topic for today's discussion is a evergreen topic. Is the correction coming? This is the most commonly asked question that we get. When is the correction coming? When can I add more to the portfolio? Should I reduce? Should I add here? All those questions. So we will try and analyze if a correction is coming soon. I'm sorry about the audio today. It may be a little muffled. I'm recording this from an airport, but nevertheless, I hope you will get the message. Please do read the disclaimer and do subscribe to the channel if you haven't. The market looked a bit weak today, minus 0.28%, but no harm done, I would say. We've lost what we gained yesterday, but in the last 5 sessions now, we have neither gone up nor gone down. So from that point of view, no direction for now. But there is a very larger picture that is emerging in terms of technicals. We will discuss that later. So Nifty for the day down 0.28%. Nifty next 50 also up 0.28%, but giving up the morning gains. It had gone up to 76,000, closing at 75,859. Not so bad. Mid caps also gaining 0.32%. So gradually, incrementally, market is inching up 0.3% on mid caps and small caps. Small caps actually raced 1.1% today. So I think the small cap move today is very, very reassuring. It is not a itchy kind of a move where you don't know if it's going up or down. This is definitely a positive outcome of the last 3-4 sessions of gradual up, and now we are flying on this. So I don't think there is any doubt that this will likely retest the previous highs. Bank Nifty again muted 0.17%, but has not lost ground. So only Nifty is the one which is looking a bit under the weather. Advanced decline ratio 291 to 206, again on the green side, positive and looking good. FIIs continue to sell at 4,000 crores selling, matched almost by DII buying 3,700 crores. So no give up in that. Last 3 sessions, almost identical numbers, 4 to 5,000 on the sell side and 3 to 4,000 on the buy side. Heat map: Reliance, Bajaj Auto, Wipro, Bajaj Finance, HDFC Life. These were the major laggards for the day. HDFC Bank minus 0.25%. ICICI Bank looking good at plus 1.9%. Britannia 1.5%. And you had Bharti move up 1.2%. These were the big gainers for the day. Within the Nifty Next 50, you are seeing more green. So you had HAL, Indigo, Godrej, CP, Varun Beverages, Adani and Sol, Siemens, ABB, DLF, all doing reasonably well. Big cuts not really present. Small cuts: JSW Energy, Divi's Lab, Vedanta, and so on and so forth. Divi's was being set to lose double-digit numbers today, but it managed minus 1.17% only on the downside. Real estate making a comeback, plus 2.1% on this. The only other sector which had a meaningful move was autos and metals, down 0.8 and 1.4%. So a bit of a mix and match today. A lot of sectors actually did not really move, neither here nor there. But real estate, you can see in the last 6 sessions, has come out of that bottom support very, very strongly. 5% on Raymond's, 5% on Shobha, 3.5% on Brigade, 2.5 on Phoenix and Prestige, Godrej, Oberoi, DLF, Mahindra, all doing well. This is good news for the real estate sector actually. Angel One, after a big consolidation in the first half of the year, is coming back very strongly. From 2000, it has already moved to nearly 3,200 and is now challenging the previous April high. If you see the longer term chart, you can see that the support of the previous high was taken, and we are now just a move away from the all-time highs. So the classic question: is the correction coming soon? So there is a potential head and shoulders pattern that is forming. So this is the left shoulder, this is the head, and this can be the right shoulder if we go down and break this. If we do that, you can expect a correction of at least 1,700 points, maybe somewhere near the election day high. That is one sort of potential that is happening. Another indicator that we can see is advanced decline ratio is gradually receding. So on average in June, if we had 370 advances to 130, in July it became 329, in August it became 246. September was slightly more than August, but not very different. And October so far, 150 gains advances to 350 decline. So overall, you can see the advanced decline ratio is pointing towards some sort of a tempering of the up move, if we may say so. If we see the 20 period advanced decline chart, it has been continuously sort of going down on CNX 500, and especially in the last many months, another indicator of that. For Nifty 50 also, it has been steadily declining all this while, this entire year. Now, these are not conclusive indicators or measures, but they can give you some placeholder in terms of, that yes, there is some indication of this that is happening. Valuations also, if we see from a valuation perspective, we are one of the most expensive markets. There is no doubt about that. But then, for instance, if we see the US market, that is also running at its nearly an all-time high valuation. Hong Kong is probably running very near that. Uh, China, after so many years of not doing anything, is still in double digits. So there is not too many markets which are growing and which are available cheap. So India, while we are expensive versus others, but we have been growing much faster. So from that point of view, 12 months forward in 20s is not so bad if you see from valuation perspective. Although I am no valuation person to give you any advice on, because I don't believe in all this. But because most people look at all this, it is good to see how generally people are thinking, and essentially we are similarly priced where we were 5 6 years back. So from that point of view, nothing much has really changed. The high P environment that is there in some pockets are also witnessing some high growth. So what will basically break those stocks is if you have high P's and the growth goes absent. If those scenarios emerge, obviously those stocks will get an hammering. And I think an example of that was DMart yesterday, where high P stock is not able to justify its growth rate. Now let's also look at long-term RSI charts. Some would say that RSI is at overbought. So every time we've hit a big action, we have seen that RSI can be at a very high point. So both in COVID and in GFC, you can see RSI was very high. But then RSI also can remain overbought for long periods of time. So you can't really time that. But definitely elevated, overheated, overbought is the objectives that are going around. We have very clearly sort of navigated the last 8 years of weekend investing through many of such periods, and I think that trying to call the market, trying to time the market has been not been so fruitful for most people. We have just gone along with our strategies, ensuring that our strategies will repair themselves if they are damaged. They will choose the best stocks, they will give up the losers, they will pick winners, they will allow the winners to run, they will allocate the capital properly. I think all those things matter more than just trying to time the market. Outside the strategies, you could be having good asset allocation, and that will help you as a hedge if and when markets do fall. Do remember that markets are not going to go up forever, and markets are not going to go down forever also. So if we get a fall, I mean, that's okay. I mean, that's part of the game. You will need to accept that, and you will also need to accept the fact that you got another opportunity now to buy low, and buy as stocks start to go higher. So markets can, of course, be irrational for long periods of time. So maybe the current environment can continue for the next 5 years. Who knows? Maybe money printing is going to go double from here in the next 2 years, and every asset class is going to go up regardless of valuation. So all those things matter because monetary base is expanding at a very fast rate. We are in a debt-ridden world. We can't survive without more printing. The moment the printing presses stop, the demand collapses. So we need stimulus, we need lower rates. The environment is such that you can't survive without that. And so uh, relatively valuation of one asset to another is probably still making some sense, but absolute valuation is not making sense anymore. So if 20 years back, when the monetary base was, let's say, 2 trillion, if something was valued at 20 times earnings, and now the base of money itself has gone up 5x or maybe even more than that, how can we now say that today's valuation versus that valuation is higher? The base money has gone up 5x, so ideally everything should be up by a dramatic amount. So you can't even compare now with older metrics because the base has changed. When you change the rules of the game, then you can't compare it with the earlier rules, and that is what is happening. So absolute valuation of anything, whether it is stocks or whether it is real estate, and it is just out of the window. It makes no sense, at least to me. It's only relative valuation which makes some sense, that yes, okay, this stock is earning so much, this stock is earning so much, what are they relatively valued at, what are the relative growth rates? Or one property is valued this, the next door property is valued this, how should they be related? Relatively, yes, some sense can be made, but nothing really on absolute basis. So again, I mean, just follow rules, just follow your process, know what to buy, when to buy, how much to buy, and when to sell. And do keep writing your comments in and sharing your knowledge with others, and others are sharing with you. Keep playing the game. Don't be afraid, don't be fearful of the market's heights. Most people will lose most of the potential by staying out and sitting out. That is my experience of the last 30 years. You please can share your experience, and I'll be happy to engage on the YouTube comments. Thank you so much. I'll see you in the next one. Bye.